Welcome to this training session on revenue cutoff for goods sales, both local and export. Let's get started. Revenue cutoff ensures sales are recorded when control of the goods transfers to the customer. For goods, the delivery order, due, is the primary form of evidence. The DO captures when goods are released, approved, and handed over. Cutoff is a high-risk audit area that requires continuous professional skepticism and sound judgment. Even a one-day difference can materially impact revenue, COGS, inventory, and receivables. Auditors must challenge dates, documents, and explanations, not simply accept them. For local goods sales, the flow begins with a purchase order and continues through sales order creation, goods preparation, delivery order issuance, customer receipt, and invoicing. The DO is essential because it represents the actual point of physical release. In most local sales, control transfers when the goods leave the warehouse. Auditors should verify how DOs are issued, approved, and logged. This includes understanding when the DO is generated, when it is signed, and when the company confirms physical release. For export sales, the sequence includes contract or PO, port entry, loading onto the vessel, issuance of the bill of lading, and invoicing. These documents, especially BL and Incoterms, determine when control transfers. Incoterms define the exact point of control transfer. Under FOB, it's when goods are on board the vessel. Under CIF or CFR, it's when goods cross the ship's rail. The XW means transfer at the seller's warehouse. DAP and DDP transfer at the buyer's destination. Auditors must apply judgment when interpreting these terms. Key red flags include due backdating, abnormal year-end spikes, DOs dated in January but recorded in December, missing proofs of delivery, and bill of lading dates that don't match the recorded revenue period. Begin by understanding the client's due process. When the DO is created, when it is approved, when the physical goods are released, and when the customer acknowledges receipt. This due life cycle forms the basis of revenue recognition for goods. Focus on the high-risk period, December 28 to 31 and January 1st to 5th. This is where most timing manipulation can occur and where your procedures should concentrate. In document tracing, auditors verify the sequence of DO, customer receipt or POD, and invoice. For export sales, this becomes due to bill of lading to invoice. Your primary question is, does this evidence support the actual transfer of control? Apply unpredictability to prevent clients from anticipating your tests. Examples include testing open or unbilled DOs, reviewing DOs without invoices, scanning for DOs issued at unusual hours, or selecting random DO numbers. These tests strengthen cutoff evidence and reveal concealed issues. Skepticism is not optional. It must be continuous. Challenge inconsistent dates, question unusual explanations, and verify whether the DO, POD, BL, or other documents genuinely support the transfer of control. Relying solely on invoices is insufficient and inappropriate. Your cutoff testing table should summarize the due date, invoice date, POD or BL date, the identified transfer point, and your final conclusion. This structured approach provides clarity and defensibility in your audit file. Examples of exceptions include January DOs recorded as December revenue, FOB shipments where the bill of lading shows January loading, PODs that are significantly delayed, or DOs that were never properly approved before shipment. Thank you for joining this training session. I hope this material strengthens your audit work and supports you in exercising better judgment and skepticism. See you in the next session.